Half a day, my name is Camile Manalac, and I'll be introducing the current liabilities ratio. So what is a current liabilities ratio? The current liabilities ratio, also known to be the current liabilities to operating revenues ratio, measures whether operating revenues are enough to cover the government's current liabilities. Accounts payable, accrued expenses, amounts due to other funds, and current portions of long-term liabilities are the accounts that are commonly reported under current liabilities. Operating revenues are usually those that come from general government operations, such as service charges, local fees, and tax revenues. It is important for external users to know if current period liabilities are greater than general government revenues because the government is responsible for ensuring that all inflows of resources are enough to cover expenses during and at the end of their fiscal years. To evaluate the government of Guam's fiscal and service capacities, the current liabilities ratio is calculated by dividing the current liabilities to operating revenues. The data found in the government of Guam's financial statements from 2016 to 2020 will compute the current liabilities ratios that are needed to help analyze the accountability and performance of the island's government. The benchmark for a current liability ratio is 0.49 and below. This is the number that governments should be aiming for. And a ratio that is 0.50 and above is considered a warning sign. This indicates that current liabilities are increasing while general government revenues are stagnant or decreasing. The chart summarizes the government of Guam's current liabilities ratios for fiscal years of 2016 to 2020 in 10,000s. The red bar displays the amount of operating revenues, while the blue bar shows the amount of current liabilities. The dark line shows the trend of the current liabilities ratio, and it seems that there are hardly any drastic increases and decreases in the ratios. The chart obviously displays a positive trend in the government of Guam's current liabilities ratio. The government met the current liabilities benchmark for all 5 fiscal years from 2016 to 2020, with fiscal years 2017 being the most efficient year for the government. The financial statement shows that the island needed less federal grant assistance during this year. This data infers a decrease in current liabilities, which explains fiscal years 2017's low current liabilities ratio. The current liabilities ratio increased at a slow and steady pace in fiscal years 2018 to 2020, but in fiscal years 2020, operating revenues increased by a large quantity. Fiscal years 2020 also had a sudden increase of current liabilities, which resulted the ratio to remain at 0.33, and this is all due to the new components of CARES Act, unemployment assistance, and COVID-19. Predominantly, the government of Guam shows no significant changes in their current liabilities ratios, revealing that the strategies of utilizing general revenues and paying off current debt did not vary in the last 5 years. Although findings clearly demonstrate that the government of Guam acquires more than enough revenues to cover current liabilities during all 5 fiscal years, there could have been more methods implemented to decrease the current liabilities ratios. The government of Guam should apply for new loans or debt instruments to pay off current or previous obligations. Debt refinancing may increase long-term liabilities, but it can easily decrease current ones. If increasing long-term liabilities is discouraged, debt reconstructing can be an alternative option. Debt reconstructing can help the government of Guam negotiate for lower interest rates and for extended due dates on current liabilities. The current liabilities ratios trend from the GovGuam's financial statements may indicate positive outturns, but others may assume that the government is not making use of the revenues efficiently by keeping extra money sitting in the fund. To improve management of revenues, another recommendation is to take a percentage of net income and allocate it to paying off current or prior year's obligations. This can decrease current obligations while also optimizing services and benefits for the public. An additional recommendation that the government of Guam should consider is to be more effective when it comes to the collectability of taxes. Delinquent taxes defer revenues, but if the government gives out incentives to encourage more citizens to pay taxes on time, it may increase income and help pay off current liabilities. Overall, the government of Guam appears to be doing financially well from the comparable current liabilities ratio of fiscal years 2016 to 2020. It is continuously important to note when short-term obligation exceeds or is close to an equal quantity of general revenues. This is an indication that the inflows of resources are not enough to cover current liabilities, which can affect current operations that benefit citizens. The current liabilities ratio exhibits if there's a growth or decrease in either current liabilities or operating revenues, which becomes a warning sign if any potential fiscal crisis may occur and if a course of action must be planned. For example, preparing for the global pandemic. When governments meet the ratio's benchmark, it may suggest that the government is earning enough to continue the services provided to their citizens. If the current liabilities ratio surpasses the benchmark in a large amount, it may indicate that the government is not responsibly discharging debt. And that concludes my presentation on the current liabilities ratio. Thank you for listening.